And Lakshman, when you look at this number, as I said, heat on the headline, but then you look at that unemployment rate and you look at the wages. How are you sort of synthesizing all of that?
Well, there's a lot. Look, you were just your colleague was just commenting, there's something in there for everybody as we dig into this data, and that'll be the case. That makes the market during the day. But to keep it simple, the headline's too hot. So this is nothing that's going to calm Powell down very quickly, or the other FOMC members. So maybe there you can dig into average hourly earnings weakening a little bit, and this and that, but just that headline is going to be, it's stronger than expected. So I think the bottom line read is it's too hot, and nothing that's going to knock him off kind of the message that he's been giving. And just to pick up on the pre-announcement conversation, construction, great place to be looking. Great place to be looking. I don't think a lot of people realize that the majority of recessionary job losses, when they come, and they're not here yet, right? They're in front of us, come from the goods sector. Even though most of us work in the services sector, most of the recessionary job losses typically come from the goods sector. So that's construction and manufacturing. We see manufacturing getting tagged a tiny bit, transportation, this is all the goods kind of stuff, right? Warehousing. So when you go to construction, I think it's very interesting what you're onto there. And I'd almost go so far as to say, oh, who's pouring the foundation? Are they busy? Or is it the finishers that are busy? Because it's like, that's your production line. You've got this backlog of construction. Where are we in that? And are they breaking ground and pouring new things and the early stage stuff? And I'm not so sure. So we have to keep a close eye on how this propagates through the rest of the jobs market.
So what sectors are you looking at that would show weakness? I mean, we did see job losses, as you had mentioned, in transportation, in information. I mean, what is it that I would think
in goods. So I would really be anything that's closer to the goods sector or that's been high flying. Okay, so obviously the information stuff has been very high flying. They hired gobs of people in the past couple of years, and so they've got to take a little off the table there, and that's what I think is happening. But the tire meets the road on the goods sector. That's where, even though it's the minority of workers, it's going to be the majority of job losses. That's how recessions work.
So, right. So can we see a recession where services is still pretty intact?
Yeah. 100. I think this is the aha moment that a lot of people don't have, is that services can grow into a recession. Services consumption may only go flat, and overall consumer consumption may only kind of flatten out, and you still have a recession. It's kind of the tail wagging the dog. And so, do we have a big come down in the real estate sector? I think that's one of the commercial real estate is something everybody's wondering about what's going on there, because the elephant in the room is that rates really went up a lot. Unexpectedly, people didn't, Powell was behind the curve, all of this stuff, so they've really gone up a lot. That's the surprise we're still dealing with from last year. And that's propagating through the economy. And I think it manifests in construction and ultimately in goods consumption.
Greg, as you look at this report, 50 basis points, what does this do to the Fed's reckoning?
I think it puts a lot of uncertainty as to what the Fed will actually do. I was saying before the report that anything north of 250,000 jobs would likely favor a 50 basis point rate hike. The reason being that Powell's testimony to Congress was very hawkish, more hawkish than perhaps he needed to be. He not just reopened the window to 50 basis point increments, but also in his signaling, in his messaging of his speech, signaled that even though he was looking at the totality of data, it was really a focus on the last months of data, which has been quite strong.
But does the unemployment rate at 3.6 and the lower wage growth, does that mitigate that impulse at all?
For me, yes. For me, what
For him,
changes the game, I think, is really what we're seeing on the wage growth front. We had 0.2% increase month over month in terms of wage growth. That is really what matters, the sequential momentum in terms of wage growth. In the end, we're not trying to fight the economy. We're trying to bring down inflation. So if you have inflation indicators like wage growth that are showing some moderation in terms of momentum, that is a very encouraging sign. Yes, wage growth increased on a year-over-year basis, but that's a base effect. Last year, wages were flat. So it's not really a sign that wage growth is accelerating. The sequential momentum is really what we have to watch for. The other thing I would note is the fact that hours worked also fell back. Revised lower for the month of January. They were very strong in the initial read, and falling back in the month of February. So we are seeing a softening of the labor market. I know the last month's data is not showing that, but if you look at the broader trend, we are seeing an easing of labor market conditions.
Mm-hmm.
What do you make of the headlines of all these job losses that we've seen in tech and in other industries as well? I mean, are you not going to see as much damage to the labor market because these people are finding work a little bit easier, because also maybe they're not submitting jobless claims because they've got good severance packages for 6 months, maybe they don't have to work for another year? I mean, what is the lag effect when it comes to these high-paying jobs that are being lost?
I think we're in a unique labor market today. We're in a labor market where over the past 18 months, a lot of executives have struggled to find the right source of labor, and they're holding on to that valued talent. So they're not going to proceed rapidly with massive layoffs across the board. And I think that's why we're seeing these conflicting signals in terms of overall trends for employment. We are seeing some sectors that are softening, but no major pullback. Look at this report. You see that it's not just information. The finance sector, the professional and business services sector are seeing slower gains in terms of job growth. That's the type of environment where business executives are making strategic decisions after 18 months of struggling to hire the right type of talent and train them. We're seeing more of a hiring reset than a layoff reset, and I think that's going to be one of the key characteristics going forward.
Could I bring into this conversation this issue with SVB and the contagion that we're seeing?
And while we're talking about it, I just want to mention here, the stock is halted for news pending. SVB Financial trading is halted for news pending. We don't know what that news is. We know that the stock plunged 60% yesterday, and it was trying to reassure customers in the bank because some VCs had called on their portfolio companies to withdraw money. Others have said they were going to support it.
Pretty much a run-on bank when it comes to SVB.
It seems to be. But now the company is halted. The stock is halted.
And we're talking about SBB Financial, which is the parent of Silicon Valley Bank. And that is a bank which services a lot of venture capitalists that are out in California, a lot of startups that are in their portfolios. So my question to you is, does Jerome Powell now have more of a difficult situation if banks start to falter? And we understand that there are larger banks that aren't as exposed perhaps to this, but does this now change the path for the Fed for its next meeting?
Yeah, so I don't think so. That's a lot. It's a big question. Look, there's credit tightening. Okay, that's the path we're on, and that's the thing that all of these businesses, banks in particular, but all investors, business managers are dealing with, is that the Fed was behind the curve. They're playing catch up. They're jacking up rates really fast. They've been doing that since last year. And whatever you were holding at that time is being impacted. And some people are trying to hold it and be like, I'm going to get to the other side. And the weaker hands are starting to show up. So when it really, to really answer the Powell question, is he willing to take a recession to knock inflation down, to keep it down? Or is he willing to is he rather going to avoid a recession and risk that wherever inflation comes down to, it's not as low as is advertised by the Fed? The Fed is saying, hey, I'm going to get you back to 2%. That's my target. I'm going back there. And that's his credibility. And when you look at history, you can look at other completely different times, but the 70s, where you had inflation cycling for other reasons, and there was a great deal of political pressure on the central bank to ease when things were getting a little rough, recessions, and they gave in. And that's why Arthur Burns is kind of a punchline and Volcker isn't. And Powell is saying, I would rather be Volcker. And there was a lot of testimony back and forth yesterday about, can we lose 2 million jobs or fight inflation? What's the deal? And he said, look, there's hundreds of millions of other people being impacted by inflation. I need to fight inflation. At least that's what I heard. So I don't know what everybody else heard.
All right, we got to leave it there, unfortunately, Greg. We'll have you back soon to talk about all this stuff. Economic Cycle Research Institute co-founder Lakshman Achuthan and EY Chief Economist Greg Daco. Thanks, guys, for joining us.